Welcome back. Let's go ahead and prepare a statement of cash flow. So do you guys remember where we said that we went to go get the information to prepare our statement of cash flow? Okay. Well, the first thing that we're going to do, I guess I should tell you the steps before we just start doing, is that we're going to calculate the net cash flows from operating activities. And remember, we're going to go to our income statement and grab our net income. And we are going to go to our balance sheet to grab changes in current assets and current liabilities. If I'm doing operating, why am I looking at only current? Because it's day-to-day revenue and expense generating activities. Any sort of like long-term assets are going to be investing, and any sort of long-term liabilities are probably going to be like more financing, right? So when we're looking at our operating, I'm going to say like 99.9 times out of 10, we're going to be going to those current liabilities and current asset sections. Then I go to my investing. And again, here's where I look at those long-term asset accounts on the balance sheet. I go look at my financing and I calculate the changes in long-term liabilities and stockholders' equity from the balance sheet. And then I'm going to combine them all and total them up and see what we got going on. Okay. So again, we go to the income statement. What do I grab from my income statement? My net income. Okay. And we're going to learn a little bit, a couple of other things that I'm also going to look at from my net income, but I know for sure that I want that 42,000. Now I'm going to go to my balance sheet over here, and I'm going to look and I'm going to analyze the changes, right, in my long-term assets, long-term liabilities, current assets, and my stockholders' equity. So we're going to do some quick math here to say, and this is, you're going to be able to have to do this on your homework. You're going to have to be able to say, okay, what am I looking at if I'm just presented a balance sheet? Well, I need to understand the change in these accounts, right? And I have to understand the change in these accounts because that represents how much the accounts increased or decreased during the current year. And my statement of cash flows is prepared, right, for the current year. So for example, cash, I'm going to read this. I'm going to say in 2027, I ended with 62. At the end of 2026, which means what I started with at the beginning of 2027 was 48. So I have a $14,000 increase in cash. And again, I want to know if that's going up or down. So I need to note that. And I'm going to do that for every single item here. My accounts receivable went up by 7. My inventory went down by 10. Okay. And my prepaid rent went up by 2. Okay. Now my long-term assets, it looks like my investments, well, those went up by 35. My land went down by 10. My equipment went up by 20. And my accumulated depreciation, well, that went up by 9. Okay, so now we're almost done. Now we just have to do our liabilities and our stockholders' equity. So current liabilities, my accounts payable went down by 5. My interest payable went up by 1,000. My income tax payable went down by 2,000. My notes payable went up by 20,000. My common stock went up by 5,000. And my retained earnings went up by 30,000. Okay. So again, when you're presented information on a balance sheet, that's going to be your first step, is asking yourself what the change in accounts are. We're going to see in a second why that's important. So then it also provides some additional information that tells us they purchased stock in Nintendo Corporation for 35,000. Okay, well, that probably sounds like some sort of an investing activity, right? Because they're going out and purchasing stock in another company, right? They're not issuing their own stock. So understanding the side of the transaction you're on is super important. I sold land for 6,000. The original purchase was for 10,000, resulting in a $4,000 loss recorded at the time of the sale. Okay, now that kind of gives me a lot of information because I sold land for 6,000. Okay, so I know that that's going to be an investing inflow, right? I'll say that's an outflow. But this loss over here, keep that in the back of your mind. We're going to have to take care of that. Okay. That's important to me. I purchased 20 grand in equipment by issuing a notes payable. Sounds like that's a non-cash item. I issued common stock. I got a financing inflow, and I declared and paid a cash dividend. Awesome. Financing outflow. So they're saying this information isn't super like readily available for you to understand just looking at the balance sheet or the income statement. So here's some additional information to help you go through your process. So what the heck do I do now? Like, I've done all of these different things. I feel like I kind of have a grasp of what's going on. Well, the next thing to understand is what method are you going to use to prepare only your indirect activities? I'm so sorry. Your operating activities. What method are you going to use to prepare your operating activities? You have the choice between the direct and the indirect method. What's the difference? Well, this indirect method is going to be more indirect, okay? And I'm not trying to be like funny when I say that, but you're not going to actually, right, go in and like book journal entries for all of these different activities. You're going to begin with net income, and then you're going to list adjustments to net income in order to arrive at operating activities. So what we saw at the beginning of this slide deck was what is presented as an indirect method. The indirect method is the most popular method. I put in here 99% of companies choose to use the indirect method because it's easier and less costly to really go in and analyze all of that information. So for that reason alone, right, that's what we're going to focus on, okay? But do understand that there's also the direct method, which adjusts the items in the income statement to directly show the cash inflows and outflows from operations. So this is just like way more time intensive, okay? So we adjust the items to directly show it. So what that means is like, how much cash did I receive from customers? How much cash did I pay for inventory? How much cash did I pay for salaries? How much did I pay in rent, interest, taxes? All of these different items, I'm going through and looking at cash paid for each individual part of my business, okay? So a lot of companies don't do it. Why don't they do it? Because it's hard. And also, if they do it, then you also have to report the indirect method. So you have to do that kind of as like, I'm presenting the direct and the indirect, or you can do it in a notes to the financial statements, okay? So what is really important about this is that at the end of the day, they're going to be the same, okay? Like you are going to arrive at the same answer, but the way that you do it is much, much different. And also, it's only different between the indirect and the direct method for operating activities. Investing, financing, and non-cash activities are presented the exact same, regardless of indirect or direct method. So again, we're going to focus on this indirect method because if you do go into accounting, this is probably what you're going to see. I will tell you too, the direct method is covered in a more advanced accounting class, okay? So here we see the bones of our statement of cash flows. Where are we getting this net income? Oh, that's that $42,000 from my income statement. Where am I getting my cash at the beginning of the period? My balance sheet. What about my cash at the end of the period? My balance sheet. So I can go over here. Oh, maybe that wasn't super productive. But we saw that we had an increase in cash of $14,000, which is exactly what we see right here by just doing our analysis of the balance sheet. So what's really kind of interesting about the statement of cash flows is that you actually have the answer, like you know what you have to get to, okay? Because I know my operating plus my investing plus my financing, well, that better add up to an increase of $14,000. Okay, because my balance sheet is telling me, right, what I need to get to and what I started with. So I already know what that net cash flow is. So I just have to make sure that I'm plugging things in right to my operating, investing, and financing. Okay, so with our operating activities, where do we start? Well, we start with our operating activities. And in our indirect method, what we do is we always start with our net income. We saw that over here. Why do I start with my net income? Because this net income is based on US GAAP accrual-based accounting. So this net income has a bunch of items contained in it that don't have an associated cash flow. So our job with the statement of cash flows is to turn around and essentially undo all of the work that we've done this semester to just get to the amount of cash that has changed hands. Okay. So I start with my net income and I say, what have I accrued for, but I have not received cash for? Okay. And also, what have I accrued for on an expense that I haven't paid cash for? So what we do here, okay, is we are going to say I have income statement items that I need to take care of, and I have balance sheet items that I need to take care of. So what we do with our income statement items is we're going to remove any non-cash revenues and non-cash expenses. What does that mean? Depreciation, okay? So again, depreciation is the best example of this, because if you think about what our journal entry is for depreciation, do I reduce my cash? Do I ever have a cash payment for depreciation? Well, no, I throw it into accumulated depreciation, a contra asset account. Depreciation is kind of like this made up accounting thing, right? Where we're like, hey, we got to recognize that my assets are being reduced in value as I use them up. Okay, I never pay cash for that, but that depreciation expense comes up here and reduces my net income. So I need to somehow back that out to show that it doesn't have an associated cash flow, okay? We're also going to remove non-operating gains and losses. What you should be thinking about is, hey, I had a loss on that sale of equipment. They told me that in my extra information. That's going to be important here. Okay, so then you go to your balance sheet items where you adjust for the changes in current assets and current liabilities. Okay, so whatever you do, know this, know how to do this, know the adjustments, the cash flows from operating activities, because I'm going to explain it to you in a way that makes sense to me, right? But at the end of the day, this chart is completely foolproof. I'm not the biggest fan of memorizing things, but if you memorize this, there's really no question that you can be asked that you won't be able to answer, okay? So in the slides that follow, we're going to cover a bunch of different adjustments to net income. So just understand what we're trying to accomplish, right? Is that we're trying to take my net income from my accrual-based accounting and change it into cash-based accounting for my operating activities to start with. Again, where do we start? My income statement adjustments. What am I going to look for? Any non-cash items, such as depreciation and amortization, and non-operating items, which are gains and losses on the sale of land, equipment, and buildings. So we're going to use Mario's or eGames Inc., and we are going to go through the process of reconciling our operating activities for our statement of cash flows. So it looks like we have net income of $42,000. Okay. And it also looks like what? Well, I have depreciation expense, and I need to go ahead and take care of that because that is a non-cash revenue or expense item. What else do I need to take care of? This loss on my sale of land. Okay, why do I need to take care of that? Well, because again, I didn't pay cash for this loss. I'm just recognizing the difference in what I was able to sell a piece of equipment for versus it's what the net book value is on my books. Okay. Cost of goods sold. Well, that has a cash piece, right? I'm paying for inventory. Operating expenses. Well, I definitely pay salaries in cash and things like that. Interest expense, income tax expense, those all have cash associated with it. So I don't need to take care of it right now. Okay. So for my income statement adjustments, we report net income of $42,000. So that's what I'm going to start with. And I'm going to do cash flows from operating activities. And I'm going to start with my net income of 42. Now go to your chart or wonder, right? how do I adjust for my depreciation expense? Because it tells me that I have depreciation expense of $9,000. I see that right here. What is this depreciation expense doing? It is lowering my net income. Did I pay cash for it? No. So when I'm looking at how do I adjust my net income, I have to add that back because it reduced my accrual-based net income, but I don't have a cash flow with it. It doesn't reduce my cash-based accounting, okay? So I have to add that piece back. Again, I sold land originally costing $10,000 for only $6,000. Where's that cash inflow of $6,000 going to show up? My investing activities, right? It's the purchase or sale of long-term assets. But where I take care of the difference between these two, hey, it cost me 10, I only sold it for 6. Well, I take care of this loss on the sale of land in my operating. So I have my loss. And again, did I pay cash for this loss? No, but it reduces my accrual-based accounting income. So just like my depreciation expense, I have to add that loss back because it doesn't represent an actual cash outflow, okay? So what that means, right, is I started with 42 net income, but I had non-cash expenses and losses of 9 plus 13, or sorry, 9 plus 4. So I have 13 plus 42 is 55, right, after I'm done with this process. But am I actually done with this process yet? Well, no, I'm not, because all I've done is my income statement. So now I need to come and do my balance sheet adjustments, okay? So remember from my balance sheet, we went through the process of, plugging all of those in. So we should know, right, all of the increases and decreases. So I've taken care of my cash. What do I need to now look at? My current liabilities and my current assets. So I'm going to need to pull through my change in accounts receivable, my change in inventory, my change in prepaid rent. Now, these long terms, I take care of those in investing. I'm not going to mess with that. That's a different section. I'll do that later. I need my current liabilities. So I have to take care of my change in AP, change in interest payable, and my change in income tax payable. Long term and and stockholders' equity, well, I take care of that in my financing section, okay? So if you go through the process of doing that, we are going to see that our accounts receivable increased by 7, okay? Our inventory balance decreased by 10, so on and so forth, okay? So again, I'm going to set this up and say I have cash flow from operating. And remember, right? Remember that I have all of the two operating expenses, or the two operating activities from my income statement that I've already done. So keep in the back of your mind, right, that this is just a continuation, right? I'm just continuing my income statement adjustments. So this is not like presented differently. It is just a true continuation where I'm saying I'm analyzing the income statement. Now I'm going to come and analyze the balance sheet. So I have my cash flow from operating, and I know I start with my net income of 42. And now I'm going to have my income statement adjustments, and now I'm going to have my balance sheet adjustments. And here's where I'm going to take care of those. So I have an increase in AR. How do I treat that? Well, I know I need to subtract that out. So again, I know I need to subtract that out because I've memorized the chart that's on the previous slide. But I'm going to show you how I like to approach these. So my accounts receivable increased by 7,000. My AR increased by 7,000. So I'm going to book a pseudo journal entry. I'm not actually going to put these in my books and records, right? But if my accounts receivable increased by 7, that means I debit that. So if I plug cash, again, I'm just plugging it as an example, I see that my cash is being reduced by 7. So if I just book the bones of this journal entry, well, all of a sudden I understand that my accounts receivable needs to be reduced. Okay. So if my accounts receivable increased by 7,000, what does that tell me? I provided, services or sales to customers and did not receive the associated cash flow, right? Because what actually probably is going on Well, I have an accounts receivable and I have service revenue. So I've recognized that, but again, I didn't get the cash. So I'm reducing the cash balance for the fact that these people made me a promise to pay me cash in the future, and that cash hasn't come due yet. Okay. So my inventory balance decreased by 10. So I have a decrease in inventory. Okay. So how do I treat that? Well, I have a decrease in a current liability. So from my chart, I should be able to know that that is going to increase my balance by 10. But I'm going to apply the same thought process over here. And I'm going to say my inventory balance decreased by 10. Okay. So my inventory balance is an asset. So I have my inventory that's going down by 10,000. I'm going to plug cash and I'm going to say, okay, I need to add that back. Okay. So if my inventory balance decreased by 10, what that means is I went through the process of selling these products to customers, and customers were giving me cash for this inventory that I'm selling them. Okay. Prepaid rent increased by 2,000. So I have an increase in prepaid rent. I have an increase in a current asset. So what does that mean? I have to remove that or subtract that out. See if you can apply the same process that what I've been doing. Okay, this is the last one that I'll do it for. My prepaid rent increased by 2,000. I plug cash. So that means that my cash has to have gone down by 2,000. So this means that the company paid 2,000 for prepaid rent, and there's no corresponding expense, right? There's no rent expense being recognized in my income statement because I haven't used the prepaid rent yet. So there was a cash outflow to increase my prepaid rent, which caused my cash to decrease by 10, but my net income was unaffected. Okay. So I need to adjust and show that my cash is being decreased, even though I didn't have an associated decrease in my net income. I have a decrease in AP of 5,000. I treat that as a decrease in 5,000. I have a, let me see here, increase in my interest payable. Okay, and that increased by 1,000. So that acts as an increase, right? So again, you can apply the same process because I'm just going through and doing this. Hey, my interest payable increased by 1,000. Okay, so I have my interest payable increasing by 1,000. I'm going to plug my cash. I'm going to say that increased by 1,000. Okay, so how does that make sense? Well, my interest payable increased by 1,000, which indicates that the company recorded interest expense, but it didn't pay any cash. So in other words, right, the $1,000 increase in interest payable reduces net income because of interest expense, but has no effect on cash. So I need to adjust for cash being greater by 1,000. So we increase, or we add the increase in interest payable to net income. Okay. So think about it. If it decreased, I would have to, back that out because, hey, my interest payable is going down, which means I am paying cash and satisfying a liability. Okay. So then I have my income tax payable decreasing 2,000 during the year. How do I want to treat that? Well, I have a decrease in income tax payable. I have a decrease in a current liability. I back that out. Okay. So when we put it all together, right, remember, I have these couple of income statement adjustments. I'm going to see something like this, where for my operating activities, I start with my net income because this is accrual-based accounting, and I reconcile from there. So I took care of my depreciation expense and my loss, and then my increases and decreases in current liabilities and current assets that come from my balance sheet. So at the end of the day, I'm going to have a net cash flow from operating activities of 50,000, which again, all I'm doing is taking my 45 plus 9 plus 4 minus 7 plus 10, so on and so forth. Okay. So after you've done this process, after you have, calculated your cash flows from operating activities, you are seriously, 90% of the way there. Okay. So the brunt of the work is in your operating activities. So with that, which of the following would be included as an adjustment to net income in the operating section of my statement of cash flows using the indirect method? Well, first off, I know that it's my depreciation because, right, it is a non-cash expense. So I recognize cash in my net income, but I didn't have an associated cash flow. So I need to back that out. Okay. So I treat that as an addition to my net income when adjusting for it. Purchase of a truck, it's my investing. Issuance of common stock, it's a financing. Payment of cash dividends, that's a financing. So now, hey, what if I received, right, cash dividends? Well, that would be an operating. So again, the first step in doing these is being able to identify, well, what type of activity is this? Which of the following items would be added back to net income in the operating activity section or the operating activity section of the statement of cash flow under the indirect method? So now I not only need to know, is this an operating activity? I need to know, when do I add it back to net income? So I have the gain on the sale of a piece of equipment. I would subtract that out because I'm recognizing an increase in a net income. Gains increase my net income without an associated cash flow. So I actually subtract out that gain. It should make sense. It operates the opposite as a loss. A decrease in salaries payable. So I have a decrease in a current liability, which would act as a decrease, right, in my operating section. How else might I do that? Well, I might say I decrease my salaries payable with a debit. I plug cash, so I know that would act as a decrease. I have an increase in the balance of accounts payable. I have an increase in a current liability. So I know that this actually is the right answer. I can also say I am increasing my AP. I plug cash, and that also gets me there. What about an increase in the balance of AR? Okay, well, I have an increase in my AR, which would represent a decrease in my cash. Okay. But I also know that I have an increase in a current asset, which acts as a decrease to my cash flows in my operating section. So, I mean, it's critical that you guys understand how to do that, right? Because if you're not able to classify cash flows as operating, then you're already not going to be able to prepare your operating section. And if your operating section isn't right, then your total statement of cash flows can't be right. So make sure you have a good grasp on this. Let me know if you have any other questions. Otherwise, I will see you guys next time where we're going to finish up the statement of cash flows by looking at our investing and financing section. So I will see you then.